Thanks, Owen, and hi to everyone.
Hello. Yeah, we try and do this quite regularly. We catch up now. But a few months ago, we did the Property Investor series on the Australian Investors podcast. So if you want to go back and hear Chris talk about everything basically there is to know about property investing, you can do that. It's about 2 months ago as of the date of this recording, and I'll include the link in the show notes. Through that series, we talked about just getting started in property investing right through to people that have multiple properties and winding down a property portfolio before retirement. Today, mate, it's very, I guess, prescient time to be talking about Australian property because there's some fear in the market. Interest rates have just gone up again in August 2022. There are kind of like people calling for these more of these rate hikes throughout the rest of the year. And I don't know what you're seeing, but I figured I had Pete Wargin on the show about 2 weeks ago,
Oh, yep.
and he said he watches your stuff and he has tracked you online a bit, and he was saying that from what he's saying, he kind of brought some calm to the debate a bit, like just kind of
Yeah.
brought a level head about quality assets and so on and so
Yeah.
forth. But you're at the coalface, mate. You're on the ground, so maybe we can start off with what are you seeing when you're talking to clients? You've got heaps of clients all around Sydney, Melbourne. What are you seeing?
Yeah. So I mean, we're sort of in August, I guess, for our listeners, just to get a bit of a reference point. I mean, we had a huge growth in the market from 2019, like soon as after Labor lost the electoral, Liberal won, rates got cut, borrowing capacities got cut, and the market had corrected 10, 15%. Talking about Sydney and Melbourne here. And really, it only slowed down in that real peak fear around COVID, like when it was the world going to go? Are we all going to die? Sort of thing. When that was really rife, we're never going to leave our homes again. Like the really market cooled off there because sellers had to be and buyers had to be brave. But as soon as that rates got cut, the market took off again in 2020 and 2021. But we could already see late 2021. Buyers were starting to say, hang on a sec, this is getting a bit ridiculous. Like, let's sit this out. Bank fixed rates were starting to go up. Like, this is almost 12 months ago now, 9 months ago. And then coming into the start of this year, a lot of global inflation numbers came out, right? And fixed rates really started to jump up. And so all our buyers started to really take a foot off the accelerator. And this is only really coming through in data now. And, a lot of people is talking, the market's down so and so percent over the last 3 months, but this is like, there's a huge lag on that sort of data. And, the changes were actually happening 9 months ago, I would say. We are in the areas that our clients buy. So we deal in the sort of the double income, high income family space. In the inner rings of, Sydney, Melbourne, Brisbane, for example, and, sister cities. A lot of those markets are already corrected. It's 10% for probably the good stuff. But up to, 20% plus for the stuff that's pretty average. Like if it's a busy road or it's dark, and those properties are really just selling, to real opportunistic buyers who are making low ball offers. And if you are forced to sell right now of those type of poor assets, you're going to have to expect a pretty big low price or a pretty big drop on last year prices. It's a bit of a seagull effect happening at the moment. The buyers are still there. So they, some are actually pulling out because their life situation's changing. They haven't got that clarity, or they really want certainty. There's that type of person who just really wants to know what's going to happen, and so they're more likely to sit on the sidelines. But the buyers are still there. They're just picky. They're just saying, look, if I'm going to pay 4, 5, 6% interest rates, I'm not going to pay that for that type of property. I'm going to be patient. I don't need to be worried about the market going up. So what they do is they all go to when the good property comes on, which if you think about it, would you sell a quality asset right now? Well, no, you wouldn't unless you're forced to, right? So there's always people, death, divorce, aged care homes, those sort of reasons to, they have to transact. But even if you're in a good property right now, you wouldn't list your property. To upgrade is a big call. To go into more debt when you're not sure where rates are going to be. And see, a lot of upgraders of good assets are just holding still. So what we're really seeing is buyers getting really picky. A bit of a seagull effect. You throw the chip to the seagulls, and that's the one good property, and everyone flies to it. And so there's good competition starting to build, I think, on the good assets because there's just so few of them. And, the poorer properties have already corrected a lot. Now, interest rates are really interesting at the moment. I guess we all knew rates were around 2% last year.
Mm.
But then when the fixed rates really took off, you were seeing fixed rates in the fives and sixes, and a good variable rate sort of around that high threes at the moment. But we've just seen since about the middle of July, a lot of calmness has come to interest rates. I think the world's sort of realizing that the central banks are taking a lot of action. They're trying to really slow down economies with these big increases in rates all around the world. And they're going to get hold of it. And, you can see in the Australian 3-year bond yield, that's come right back down. And so what we're actually seeing even today, the banks are actually starting to reduce their fixed rates. So that means that the fear rates were going to go to 5, 6, 7% in June, that's not really there anymore. A lot of the banks and a lot of even the big banks are forecasting that rates are going to increase, for the rest of 2022. But then, depending on how the economy's going, depending on inflation gets under control, we're actually potentially looking for rate cuts next year, which is a big turnaround than the fear just a few months ago.
See, that's something that I'm thinking about a lot, just from the other side of the fence. Like if I look at fixed income markets, right? Obviously, we're looking forward, and there's been a massive shift in consumer sentiment across all of the readings, and like you said, they're lagging. But basically, everywhere I look, people are more concerned or cautious. Mortgages going up $500, $600 a month, repayments. It's a meaningful amount of money to a lot of Aussies. And if I look at it from the fixed income side, from the stock market side, I guess the question that we're getting now is, bonds have been terrible performers for my portfolios, things like that. But now, I think if you look further afield, there will come a time when rates reverse. So I don't know when that will be, but it will happen. How about then? So, like my personal experience with your team recently is trying to refinance our home, and I was looking in the data before I jumped on the chat just a minute ago, and it looks like in major capital cities that, like at Melbourne and Sydney, I'm speaking of, prices are only down 3% across median house prices. And in our case, our sample size of one being in Melbourne, it would seem that our property is still well up of where it was 2 years ago. So I guess, what are you seeing in the mix there and around people refinancing, investors, homeowners? Are they still getting, are they still seeing that capital increase from when they purchased?
There's a real mixed bag. I think the top end, the upper quintile, is the ones that rose the most. Like you can see that in places in Brisbane. We had clients where properties doubled in 2 or 3 years. All the inner rings, sort of old Queenslanders, etc. And so you've got to expect, the FOMO that drove those markets under 2% interest rates has to revert. Some of that growth has to come off if rates go to 4 and 5, etc. But some of the markets haven't risen as much, and so they're not. And I don't think they've fallen as much, anywhere near as much as sort of the upper quintile. And vals are always a bit of an interesting thing. We get a real mixed bag with vals. Sometimes the valuer wakes up and is having a bad day and is putting a really conservative val on. We got one of those last week. A client was super disappointed, and it's just they bring in their own opinions a little bit rather than looking at the facts of what's sold in the last 3 to 6 months. And so, yeah, it is a real mixed bag. I think you just got to be really careful what you own right now, because you have to think, if interest rates do stay high, and they don't go up and then they don't come back down, is your property still a good bet under 5-6% interest rates? Is there still do people still really want that type of property? And that's the risk right now, is that you get a better deal than 2021, but if rates do continue to go up and they stay high, do you see that there's further price falls? And some parts of the markets would be susceptible to, if rates stay high for a long period, when you talk about those mortgage repayments going up, if they go up for a year high, people probably find a way through. But if they stay high for 4 or 5 years, you are going to see debt stress, particularly in high density, first home and house and land packages in fringes, and even the middle and outer suburbs of capital cities, where they paid a lot of money in 2020, 2021. And they're starting to pay bigger mortgages as well, and maybe potential negative equity, etc. So it's really a question of whether rates do stay high and if they come back down. But just over the last 2 months, you can start to see the market doesn't believe that's going to happen.
Yeah, that's interesting. So So what you're saying? So what's so before you said the banks don't seem to be like there was a cut to a fixed interest offer.
Yeah.
Is it just the banks that are giving you that signal, or is it more so from investors as well? Like, how are you seeing that? How are you getting, I guess, that insight?
Oh, so we just literally, the big yellow bank today came out with a 4-year fixed rate at 4.99, which, and all the other fixed rates are in the fives and even up to 6. And so for them to come and offer this, fixed rate, it's a bit of a game changer, to be honest. And Macquarie came out last week actually and changed their fixed rates down. So it's just that the
Right.
banks are more certain around their longer term funding. They've got more options. The yields have come down on bonds, etc. So then, yeah, and that's even in the AFR this week. There was an article that's saying, the market thought the RBA would go up into the 4s. But now and no one all the economists in the country didn't think that would happen. They were all saying 2 to 3. And now the market's saying, the RBA is probably going to get closer to 3. So I think there's just that sort of that shift. I think on a ground, we, in May and June, talking to clients, everyone was very, very nervous, right? It was just the speed of that second rate increase. I think that really scared. And then the back-to-back 50 basis points. People didn't really understand how far is this going to go. I wasn't expecting. I think it just caught everyone off guard. And everyone's a little bit more depressed in winter anyway and negative. So I think that compounded it. And I just think, but that really shifted, I think, in July. I think a lot of our pre-approvals said, look, yeah, we still want to buy. We're not too, we've redone our numbers on 5% interest rates. We're still comfortable with that, but we're going to be really picky and patient. But then in the last 2 or 3 weeks, we've just seen our inquiry start to pick up. And people are a little bit more like the opportunistic. There's like 2 types of upgraders. There's upgraders who do it for lifestyle benefit, even though they don't need to. They're doing it for a better life and a better property. But they've got enough space and room, and they're in an area that they are happy with. But then you got the upgraders who are people who are living in apartments, like a 2-bed apartment with 1 or 2 kids, right? Or they're in a 2-bed house that's too expensive to renovate or doesn't really make sense. Those people who have to upgrade in the next sort of 1 to sort of 5 years, they're the ones who are starting to come to us and saying, well, you know what? Now's actually that trade-off of upgrading makes a lot of sense. And another big thing in Sydney is obviously the stamp duty changes that may or may not happen, in the next, 6 to 12 months, where the state government's going to waive stamp duty for first home buyers up to 1.5 million, which is a big game changer if you haven't bought, because it potentially reduces your deposit by, a third of how much you really need to buy something. So, yeah, there's lots going on.
Just on that for first home buyers, I've heard in the past, when not just in podcasts with me, but I've listened to some of the other podcasts that you've done, and you've talked about how the first home buyer incentives can sometimes create kind of this artificial ceiling that then prices push up to anyway. So it doesn't really solve the affordability issue. Like by going to 1.5 million, is that just a game changer? Or
it absolutely does not solve housing affordability. Housing affordability and solving is a huge issue, and there's so many elements. And the last thing you want is demand increasing policies, right? Which is what this is. This isn't creating more supply. This is just bringing forward people who are saving for a deposit and saying you don't have to save as much so you can buy today. It's like a credit card for the property market, to be honest. And the reality is, though, this is this is how the market works. The system is to support prices. And so rather than getting angry with the system, it's kind of like, well, this is actually how it's going to change things. What do I do next? But if you think about it, like you've got let's say a couple, and they're on a couple $100,000 a year combined, and they wanted to buy a house at, I don't know, 1.2 million, right? Or $1 million, just round numbers. Now the minimum deposit they'll need is a 10% deposit, which is 100 plus 5% for stamp duty, it's almost that. So about 150,000 they would need as a deposit. Post legislation or post when it, January next year, they'll need 100,000, maybe 105. So if you're a young couple now and you're at 80,000, to get to 150, it feels like a long way away. But when you go and speak to a broker and they say, well, actually, you only need 105, well, we can get there. That's 3 or 4 months of good saving. Maybe we could ask the parents, my brother, and it just brings, and there'll be a lot of media around it, and a lot of hype that this is a game changer for first home buyers. And I think just that instantly, you'll have more people going to open homes, more people getting pre-approved. And the stuff that's pretty poor, the pretty average properties, under 1.5, there's still going to be a supply imbalance. High density apartments in areas where families don't want to live, that's not going to all of a sudden just increase, suck up all that supply. But in areas where there's already low supply, like, older apartments in more premium suburbs around Sydney, houses in, say, Central Coast, Wollongong, that are under 1.5, I think you'll find that very quickly the demand outweighs the supply, and that 5% that you saved on stamp duty, you end up paying more in the house price. But the benefit is you get to buy that, you still get to purchase that, so you get the future growth, but you do have to pay more for it at the start.
Okay, so switch gears now to go to the other end of the spectrum. With like we could say, like these more expensive homes coming off the boil, so to speak.
Yeah.
Are you surprised about that?
Oh, not at all. It really, they were getting priced because the more expensive a home is usually attached to a lifestyle benefit, right? And people were like, wow, if rates are so low, I'm going to upgrade. I'm going to go and buy that additional lifestyle benefit because I can afford it at low rates. Plus, and it was getting a bit silly in 2021. I remember just some prices, and I just think, far out. That is like 50, 60% above what that would have sold for 6 months ago. Like just the FOMO of craziness where people were going to. And so I think that's what happened. The market just got ahead of itself. So yeah, absolutely doesn't surprise me that it's what you're finding is though that in this market, the good stuff people are now holding on to because property is always based on, the marginal buyer theory, right? So if everyone says, the property market wouldn't be worth $10 trillion if everyone sold today. Well, it's never going to happen because everyone needs somewhere to live, right? Whereas shares people can sell. But I mean, so property is really only based on how many properties on the market in the area that you want to buy. And is there enough demand to make sure that, that skips the sales to more demand than supply. And so what you're finding here now is that good property, people who are in them, as long as they can afford the mortgage, which a lot of the people can. The reason they've taken on those bigger mortgages is because they're confident around their future income, which isn't getting factored into the debate a lot. A lot of people say, their expenses are going up. Yeah, but then you're not seeing the wage increases. Yet maybe as a whole market or a whole country level, we're not getting major wage increases. But that doesn't factor in, the 30-year-old that just got a big bump because they've taken a promotion or they've just got headhunted to another job. That's giving because there's a talent shortage in their industry. And that's what we're seeing. We're seeing some pretty decent whacks in terms of people's incomes going up over the last few years.
I was looking at the numbers, just looking at prop track numbers before the show.
Yeah.
And I saw that annually, so just 12 months, unit prices in Sydney were negative, which, again, I can't say that I'm surprised about. And we've also seen, I guess the thing that I was maybe more surprised about was, even though we are seeing a bit of a kind of a cooling off, regional hubs and regional cities, like you said, I think you call them sister cities, along the eastern seaboard in particular, are still really strong. And I think it's important not to forget that they've gone up in some places 50%, since pre-COVID.
Yeah, so we saw the flight to regions happen. I remember all the conversations sort of pre-2017 when there was that the height of that Sydney boom. It was a pretty, rates were a lot higher. People were thinking, God, I've got to go into this debt to get security for my family long term. And we'd have the conversation with clients like, why don't you look at the Wollongong, north of Wollongong? Amazing lifestyle. Why don't you look at these parts of the Central Coast? Pretty good place to live. And no one did it, to be honest. Very few, because they were stuck to the 9 to 5 in the city, couldn't justify the commute. But as soon as the COVID situation happened, bang, it was like a rocket. And everyone talked about a tree change or a sea change. But I feel like it was like it's a social proof thing, right? So once they saw their friends doing it, people like them did it, maybe we should do it too. And we're not going to be the crazy ones. And so that happened in 2020. In 2021, it still continued. People had to make compromise in 2021 because the best areas of those locations really got out of reach. So in the Central Coast, like the Avoca or the Thirroul in north of Wollongong, or the best parts of Geelong or Mornington. And so people are like, well, if I have to move down there and I don't get to live in the best suburbs, do I still want to do it? Secondly, I think the return to work policy started to, nothing was really in their contracts. Nothing was really, they were worried if they swapped jobs. And I think like people really retreated back to the inner ring and the capital cities and the apartments. I mean, when you say about their Sydney units being down, like a lot of places in Sydney, the units never even went up. If you look at high density places around Waterloo, Rosebery, Epping, St. Leonard's, Parramatta, the Sydney market boomed. The people who own those properties didn't get a boom, right? They even under 2% interest rates, they didn't go up. So that's telling you something, right? So if they didn't do well under 2% interest rate, how are they going to do well under 4% interest rates? So I'd say that's a big part of it. But I do think, if you looked at some of the more lower density, more premium suburbs in the unit markets, places on the lower northern beaches, the Mossmans, the Cremornes, Neutral Bay, Rose Bay. This is Sydney. Melbourne's a different story with the units, but I think you'll find that the growth and their holding value, but over 12 months, they'd probably definitely still be up. So, but yeah, and what interesting, while I was going to finish that story about the regions is, so wave 1, 2020, wave 2, probably 2021. And I was worried whether we were going to see another wave to the regions. I wonder if it's going to really run out. And just in the last, probably three to 4 months, we've seen it like a bit of a bell curve. So we see the clients that have got depending on their industry and their profession and their I guess how far up the corporate ladder they are as well, in terms of their age, they're getting a bit more certainty. Work's basically saying, look, 1 day in the office a week, 1 day a fortnight, 2 days a week. And they know if they looked out in other jobs, they're also offering the same thing. So they're saying, look, even if I want to switch jobs, that's okay. I'm not gonna shoot myself in the foot. But then I'm seeing the bell curve the other side, where people thought they were going to get 3-4 days at home, and they're getting 2, and they're getting 1, and they're getting dragged in on their day off, and they're not getting any. And especially more middle and upper management, they're having to drive teams and get into the office more. So they're not going to obviously go to the regions. They're looking at the inner ring houses again, the bigger houses in the middle ring. And then the people who are getting lots of hybrid, they're looking more at the regions. It's crazy. Even in the last week, we've had 4 people looking up in the Blue Mountains, which, it's just, we get them occasionally, but that shows the flight. Like, that's a long way from the city. And, it shows the confidence in them in their work.
Yeah, because I must admit, that's one thing that I worried about. The regional hubs, particularly in Melbourne and Victoria, I should say. I thought we would see them fly back to the city, but for the most part, maybe that's not happening. And it's probably good. A lot of workplaces have been forced to change and forced to adapt and be kind of what we would say anti-fragile, right? One of the things that is probably a bit interesting is kind of any changes to like stress testing. Typically, what is it when a mortgage broker like yourself runs by a bank? They had a buffer of 2%, maybe more. Is that changing?
Yeah. So what happened is in 2021, they're worried that the market was, which is rightly, the property markets were going nuts, right? And they go, we've got to slow this down. So APRA came in with a pretty meaningless adjustment to the assessment rate and said, look, if we're lending you money at 2 to 3%, we need to make sure you can afford it if it's 2.5% above that. And they just said, look, we're going to change it to a 3% buffer, not a 2.5% buffer. That's a 5% reduction in borrowing capacity. I was very vocal at the time. I said, look, that's just waste of time. Like, that's not going to slow the market down. What's going to slow it down is higher rates. And absolutely, as soon as higher rates came, that's what slowed it down. So the APRA have at the moment got a 3% buffer. You got to think about this. If this sort of continues on, there's going to be things that they try to do to support prices. They don't really want to see a housing price crash. That's great for first home buyers and people wanting to get in, but it's not great for the other people who own property who spend and drive the economy, right? And the wealth effect. So they'll do things to protect the market. And so that's one thing they may do, is they may reduce that, APRA may reduce that buffer if there's any type of, this goes on for a bit, together with, first home buyer incentives and a few other things. The big thing that's happening right now is that, interest rates are going up. And so that's changing how much debt people want to go into, right? So if interest rates are at 2% and likely to stay there, you're more gutsy to go for more debt. But when rates are going to be 4 or 5%, you're like, oh, I'm not going to go into it. So you're reducing your budget. So buyers are doing that already. But 1 in 4 or 1 in 5 buyers were going to their absolute max in 2020, 2021. So they were, let's say 25% of buyers, right?
Mm-hmm.
Those buyers, if they still want to go to their max, they can't go anywhere near as much in 2022 because as interest rates go up, borrowing capacities fall. It's a real headwind for the property market. When interest rates go up, people want to borrow less, but B, you can borrow less. So credit growth is actually less. And so the buyers that right now who want to stretch to their max, they can probably borrow, I would say 20% less than what they could have borrowed in 2021. And so that's really slowing down. And that's when we talk about the top end. A lot of those people will use all their borrowing capacity because they've got a huge amount of equity and they've got, strong trajectory of incomes and maybe they've got other buffers and things like that. So, I do think that's sort of something that's played out. But I think it's already played out already. A lot of people think, something doesn't have to happen for it to impact that, and then so just the fear around rates going up meant all our borrowers reduced how much they wanted to spend. So they didn't really want to spend their full capacity anyway. And so I think that's already playing out.
Chris, it's a bit of a tense question for a lot of people. Do borrowers pay attention to RBA rate statements and in particular forecasts?
Look, I mean, a lot of people do want to know what their rates are, right? But I do think it's really a timing thing. People do that when they're buying, and they're very conscious of it. But we can just know by the mortgage market that after they're bought or after they've refinanced, is they forget about it. Because if they did really care, what they would do is refinance their home loan. Because the best way to soften the impact of a rate rise is to go and get yourself a better deal in the marketplace. And the bank's profits have basically been supported by something called the loyalty tax, which has gone out of control in the last 12 months. So the way that it works is when you get a home loan, you negotiate a discount off that home loan rate. And for the only way to get a better rate is to increase your discount. Now, a bank's never going to call you up and say, hang on a sec, Chris or Owen, I can give you a 1.5% discount. You're only on 1.2. So unless you call them and go to retention teams or refinance to another bank, you won't get yourself a better deal. And what they do is they increase that discount for new customers. And, when I started in broking, 8-9 years ago, a good discount used to be 1 to 1.2%. Now good discounts like well over 2%, even up to 2.5%. It's crazy. So new customers are getting huge discounts on their mortgages. Existing customers are getting very small discounts. And so that just shows, Owen, that not many people really care so much about their rates. It's because they're not taking action. And in the last couple of years, refinances has gone through the roof. But longer term, people are pretty lazy on their mortgages, and that just plays into the bank's profits. So if your mortgage is even 6 to 12 months old, just make sure you're on a good rate. And a good way to think about what's a good rate is, I love easy things you can put in your head, right? So you can always don't have to go type into an Excel spreadsheet. Look at what the RBA rate is, 1.85%. Just add 2% on top of it. That's roughly the bank margin. So if the RBA goes up to 2.35 or the RBA goes to 2.5, add 2% on top of that. And that's ideally what you want to be getting your rate to. If it's an investment property, add 2.5%. And that will give you a really good understanding of roughly what a good rate is.
Okay, that's great. How about Phil Lowe's statement about not increasing interest rates?
Look, he was trying to use every tool in his armory, right, to say that we did everything we could to support the economy. He couldn't cut rates any lower. He was doing money printing and giving banks money at 0.1%, hundreds of billions of dollars. The only thing he could also do is offer really strong forward guidance for people to say, well, you didn't actually do what you could. So he basically did everything he could, and he stuck to that case a bit too long. I think that was his issue. I think what he did was probably, when he did do it, was probably the right thing to do. But what it did actually do is it created a asset price inflation, right? And it probably sent the market into a real spin. But I mean, it was also trying to give households confidence to spend their money. So I just think it really backfired on him because he probably should have changed his tune earlier. Rather than this, we are under sort of overstimulated the economy for too long, and then we've done it wrong. Now we have to massively increase rates and freak everyone out. They potentially should have slowly increased rates last year. But this isn't just an Australian issue. Lots of central banks around the world got it wrong. I'll give him a free kick there. I don't think he did the wrong thing. I just think everyone got shocked with the global, inflation issues. How people have been wanting inflation for years. Rates on the UK have been zero since 2008. They haven't been, and part of that is because they haven't been able to get inflation going. And so, yeah.
Well, here it is.
Yeah. Yeah, which it might be because of COVID. It might be because of the war. It might be because of the fuel. It might be because they've overstimulated it. It might be because of, there's lots of reasons, but it hasn't just all of a sudden happened. It's been, a long time coming.
Okay, well, I figured what we might do is we might end the chat with just to kind of maybe to pick your brains on some advice for whether you're a first-time buyer, whether you're an upgrader or an investor. Those are kind of the three big camps that we covered off in the Property Investor series. Maybe I'll just cherry pick one first before you get to those three. Should people consider fixed rates at the moment, or should they not?
Well, this change from CBA today and Macquarie last week is making it more likely to consider. I would say no at the moment, but that's not to say I would say no in a few months' time. Especially if you are taking on a bigger debt and you want certainty and, bad news is starting. But at the moment, I feel like the news cycle is starting to flip like the other way with rates. You can see that with, yields, etc. That's probably answered the question. Not right now, but that's not never. Generally speaking, you're going to win on the variable rate over the fixed rate, especially if you negotiate every year and you switch banks and you stay on top of it. That's just historically. But, we fixed 80, 90% of our clients and 80, 90% of their loans for the last 2 or 3 years in 2020 and 2021. And they're all sitting pretty. Yeah,
for a little while longer. Okay, mate. So let's cover off these three bases. Then we've got first-time buyers, upgraders, investors. What would you be saying to them if they were sitting in front of you right now?
So all of it, I'd be really careful reading mainstream media. Very, very well respected.
I was actually going to ask you about that because there's some crap out there, honestly.
It really, like when you were talking about evaluation of your property, that's exactly right. So you're talking what's happening to your property in your suburb, in your street, and those type of properties in that suburb. Are open homes busy? Is there many of them on the market? You need low, because you don't buy the Australian property market. You can't go and buy the index and say, I actually don't want my house price growth. I want the Australian property market. You get what you buy, right? And so what you really need to do is get on the ground. And if you really want to know what's happening, get out to some open homes, go to some auctions, see what's happening. And that could be completely different to what the mainstream media is trying to do. They're trying to peddle fear or peddle likes or peddle followers or etc. And I do feel like some of them at the moment are just sort of taking advantage of it. And they're losing a bit of credibility because they're very well respected commentators and they've done very well in the past. But what they're doing now is not providing any context. They're focusing on the negative news story and they're trying to get lots of attention by perpetuating, because there's a lot of people who want to see the Australian property market crash, but maybe they want to buy. Maybe they didn't buy and they wish they did buy, or maybe they just get frustrated with the unproductivity of housing. There's lots of reasons why, there's issues with the Australian property system, which we're very aware of. But then they jump on this negative news cycle and then they start to perpetuate it and things like that. So be very careful right now listening to things. Get on the ground, look at your properties, and it could actually be worse than what they're saying. Like if you've got a high density uni on a busy road and there's 700 on the market, things are pretty tight. It probably lines up. But you might find your houses in your suburb, there's 1 or 2 on the market. And you know what? It's actually still quite busy and they're still transacting and they're still holding prices. So that's the first thing. Does that answer your question? Yeah,
it does, because it kind of covers all bases. I think in like the 5 suburbs around me, there's 2 houses to rent.
Yeah.
And there's less than a handful of properties on the market in the suburb, and they would be pretty low quality anyway. So, Yeah, I mean, that just was a reality check for me. We're not in a fringe suburb. We're not in any of that sort of stuff, as you know. So we're pretty lucky. We bought well, and I think that was the key. And we bought at a good time. We bought 2 years ago, and yeah, I mean, we were very lucky with the timing. That's luck.
Yeah.
But yeah, I mean, what about investors? Like, have you seen
Yeah.
anything property investors that's concerning?
So investors really were in the market a lot in the 2012 to 2017 boom. That's what that boom was mainly driven by, is investors being able to borrow a ridiculous amount of money, way more than they can borrow in 2022, 10, 12 times their income. They can get interest only, and the credit policy there is light and day for what it is today. So they really took a step out of the market. There was all the issues with negative gearing and interest-only loans. But we did start to see investors are funny. They don't want to invest when they should be investing. Same in stock markets. They only want to invest when they realize they should have invested earlier. So they come to the party late, right? And so they were coming to the party in late 2021. Maybe I should buy an investment property, because I should have bought one last year. So investors are coming in. We started to see at the start of this year as well, like where home buyers started to drop off. Investors started thinking, maybe it's a bit more opportunistic. Maybe I should buy. So they were coming to the market. The problem with investors right now is borrowing capacities are absolutely coming down dramatically, and they're going to come down harder for investors than they do for home buyers. And that's the issue right now, is that even if you do want to go and buy an investment property, you've got to be in a really strong position on an income point of view to go and buy enough money. You can always go on down the quantity strategy investments, and we all know about the spruikers who buy a property every month, etc. What they're peddling is buying cheap stuff that's cheap for a reason, and buy lots of it so we can get paid multiple times. And that stuff we go nowhere near as a business. So those type of investors are out there, but if I was anyone listening to this, I wouldn't be going near that stuff. So the issue investors have got now is to actually go and buy a quality asset. A lot of them haven't got the income to do it. They've got equity, but their borrowing capacities have really reduced. And so, chatting one tomorrow, probably thought he could borrow close to $1 million. It's like 500. So it's like, well, there's no point buying something at 500. Let's just keep that capacity, increase our incomes. And so that's for investors at the moment. But if you are being an investor, you want to play on the long-term fundamentals. And this is what we've seen really recently in the last 2 or 3 months is, in a hot market, it's really hard to buy the good stuff. The best streets, the renovated properties, the stuff that really everyone wants, because you've got a big buyer pool, and the ones who've got the most money flock to the best properties, right? And you've got to basically be the one with the most money or get lucky somehow in a hot market to get a good asset. So what ends up happening in hot markets, unless you want to pay well over the market price, like 10, 15% above what everyone else is thinking, that's because that's how high prices get made. You can't get quality. You make compromises in hot markets. You make compromises on the road, the aspects, because rather than being out of the market, it's better to be in it, right? And unfortunately, in hot markets, you just don't want to make too many compromises, because when the market turns, you get smashed. So we try to always stop people is like make compromise on the right things, not the wrong things, right? So that's unfortunately one of the dangers. In the hot markets, buying is really hard to buy the good stuff. You've got to buy something in the middle. In the down markets, what you're actually finding is it's actually really hard to find the good stuff, but there's less competition. And if you do hear about it first, and you do get access to it first, and you're fast and you make a solid offer, it's more likely you're going to be actually pull it off, because the person with a quality asset is hearing all the negative news. They're seeing auction clearance rates, and then they get the agent in the ear who's worried about listings, who just wants a sale. And if you're just act fast and they get a good offer on the table, that doesn't, not a big offer, but just a solid offer, it's really gutsy for a vendor right now to say no to that offer, because no one wants to be that person in 2 months' time and says, I turned down $1 million. I had to sell it for 900. And so what we're seeing at the moment is the clients who are ready, who are picky and patient, and they get some type of advantage like access. They're hearing about something. If they make a solid offer, they can pull it off. So I would just say right now, if you are an investor, upgrader, or first-time buyer, it's about being in the market, not sitting on the sidelines, being super patient and picky. And then when a quality asset comes on, don't sit back and try to because competition can build. So if you do, and now's the time, if ever, to use a buyer's agent. You think now's the
Right.
easy time to buy, but what you want to use is a buyer's agent now to get you that first access and to be able to put an offer together first, and then to actually get that offer to the vendor and try to get that exchange before anyone even knows about it. And so that would be my advice at the moment.
Is that because a lot of properties might go off market if they can, if the
Yeah,
agents push it through off market?
yeah. Off market is sort of one where no one really ever wants to list it on the market. It could be divorce, something private. They might not want to do open homes, and they might want a lot of money for it. There's lots of reasons why off market's on there, but something called pre-market. So I want to sell it, but I don't, but I don't mind if we sell it fast. And so, or if I can get a certain price, I'll sell it. And so, and at the moment, sometimes vendors are testing the market. They're like, well, I'll sell it. So I'll do this pre-market, off-market thing. But a typical pre-market is like, yeah, we've got the photos booked on Thursday. Stylists are coming next week, but they haven't been here. Maybe the house isn't perfectly ready. But the agent said to the vendor, look, if I can get you $1 million, would you consider that? I'll go to a couple of people in my contacts, your hot buyer list, and on the top of a hot buyer list is buyer's agents. So you'd have, a pre-approved buyer that's been bidding on other things, and the agents know everything about them. Yet they're hot, right? But then the buyer's agent that's got a pre-approved client, they know that buyer is even hotter because they're not going to stuff them around. So buyer's agents will be the ones who get the access first, the special treatment. And if you've got two offers together, a buyer and a buyer's agent's offer, they're going to put more weighting on the buyer's agent because they know there's more certainty around that offer. The buyer's agent isn't going to stuff them around. And so that's the real benefit at the moment, is that you're more likely to get access and preference. In a hot market, though, the good property comes to the agent. The vendor says, just go to auction. I don't care about the offers.
It doesn't matter.
And so then that's why buyers agents sometimes in hot markets on good assets, the value can be limited. It can definitely still worth engaging, but it's not as strong as I say right now.
For those people that have never bought a property before, be sure to check out our property course on Rask Education. It's got Chris and Amy Lenardi on it. It's fantastic, mate. I think that just about covers everything at the moment. I think you've given us like a good grounding on what's kind of going on. Maybe one final, just quick one. You said before that kind of stay away from the mainstream press a bit. When you look at property data, where are you looking? Where are you getting your info from? Like, what are the things that you look at, or who do you follow to kind of get that perspective, I guess?
Look, I mean, one of the benefits of we do our podcast is if I've got a question about something, I go and find someone, right? And I'll learn about them, etc. So, I would say look at some of the guests on there. That would probably be a good option. Yep. Go through our guests and sort of see there. I mean, I do use a real mix of stuff, to be honest. I want to know how cities are evolving. It return to work. Anything around that, I love reading about it. What is happening? What's happening with and so it's a real mix. What's happening with regions? What's happening with construction? I follow all developments in the city and want to know what's happening with commercial, etc. So it is a real mix. Pete Warden's obviously amazing. I know you mentioned him before. It's like we're fans of each other, but I do think he's a very great, well-written blog that you get. And so I definitely think I've learned a lot over the years. And that would probably be the main ones. The only other thing I was meant to say, Owen, around the strategies is the upgraders right now. Is that, if you are in a camp where you do need a bigger home long term, it's really hard to do that in up markets, right? And so because the properties that you want to buy into, they're the ones that are probably growing faster and that gap's bigger. But in these down markets, they're the ones that have come off a bit harder because they're a bit more expensive. And so if you're in a fortunate position where you've had a property, you built a bit of equity in it, but now your incomes have gone up, and you're higher than when you first purchased that property. Maybe young family is here now or is coming. Now's probably a time to say, now's probably a good time to think, should we do that upgrade now rather than doing it when we absolutely need to do it in 3 or 4 years' time and then being at the mercy of the market? Because that transaction's never easy. The stress of buying and selling and how do you do it and how can you borrow and having to find it and then, so it's a really stressful thing. So no matter when you do it, it's going to be painful. but I would argue that if you have a crack at it now, it might not be a bad time.
Okay, that's great. It's good to know. Chris, obviously people can find you at wealthful.com.au. Links will be in the show notes. Be sure to go back to the Property Investor Series. If people want to listen to the podcast, mate, where do they go?
Elephantintheroom.com.au.
Yep, you'll find all the episodes there. Great guests. Some of the background that I do on you, mate, is from that podcast. So I go and listen and get my questions and my talking points. So if you want to hear more from Chris and the team, be sure to go to wealthful.com.au. Otherwise, mate, enjoy your trip overseas, your holiday, your break away from work, and we'll see you next time on the Australian Investors Podcast.
Thanks, Owen. Thanks all. Cheers.